Imagine person A owns a small bakery in their town. Could be in France, Brazil, the UK, Australia, anywhere in the world. They want to grow their business and get more customers, so they decide to advertise online. Instead of using a local newspaper or putting up posters, they go to Google. They buy ad space, those ads you see on YouTube, on websites, or in search results. Person A pays $1,000 to run these ads in their area. Google takes the money, shows the ads to thousands of people nearby, and soon more customers start visiting the bakery. Sales go up. Person A is happy. But here's the catch. Google just made $1,000 from a business in that country, but the money doesn't stay there. It's usually sent to one of Google's international offices, often in countries like Ireland, the Netherlands, or Singapore, where tax rates are very low. Even though Google earned money from a local business and local customers, it doesn't pay much, or sometimes any, tax in the country where that money came from. Now imagine this same thing happening with millions of small businesses in countries all over the world. Google, Facebook, Amazon, they're earning billions every year from ads, app sales, and digital services without contributing fairly to the countries where those profits are actually being made. A Google tax, formerly known as a diverted profits tax or digital services tax, DST in some countries, is a modern tax policy designed to prevent multinational companies from avoiding taxes by shifting profits to low-tax jurisdictions. It specifically targets large tech firms like Google, Facebook, Amazon, and Apple that operate across borders and often structure their finances in ways that allow them to report profits in countries where they owe little to no corporate tax. This practice is called profit shifting, and it's commonly done by routing sales, intellectual property royalties, or advertising revenues through countries with favorable tax laws, such as Ireland, Netherlands, Luxembourg, or Bermuda. These arrangements are usually legal under current international tax rules, but many governments argue they are unfair because they allow companies to make billions from local markets without contributing a fair share to the public finances of those countries. For example, Alphabet Inc., the parent company of Google, reported $6.5 billion in revenue from the UK in 1 year, but paid only a small fraction in UK taxes. This was possible because Google structured its sales contracts and licensing through its Irish subsidiary in Dublin, where corporate taxes are significantly lower. As a result, even though most of the business activity and user engagement happened in the UK, the actual taxable profits were recorded in Ireland. To counter this, the UK introduced the diverted profits tax in 2015, which imposes a higher tax rate, currently 25%, on profits that are deemed to have been artificially shifted out of the country. Other countries followed suit with similar rules or introduced their own versions of a digital services tax, typically a 2% to 7% levy on digital revenues earned within their borders. The broader goal of the Google tax is to ensure that large digital companies pay tax where their users and customers are, rather than where their headquarters or legal registrations happen to be. It's part of a global effort to modernize tax systems in the age of digital commerce and address the growing imbalance between traditional businesses that pay local taxes and digital giants that often do not. This raised a big question. If tech giants make money from businesses and people in a country, shouldn't they also pay tax there, even if they don't have a physical office? That question led to what we now call the digital services tax, or informally, the Google tax.